Okay, good morning, everyone, and welcome to this morning's session of the Coffee Microcaps Morning Meeting. You're very welcome to this morning's event. If this is your first time joining us, my name is Mark Tobin. I'm the founder of Coffee Microcaps, and for all our regular attendees, welcome back to today's session. I'm just going to quickly run through a couple of intro slides, and then we're going to get straight into it with our first presenter. First off, I'd like to mention our sponsor for all our online events here at Coffee Microcaps, RAS Research as a Service. If you are looking for information on small and micro cap companies that are not necessarily covered by the other brokers, please do check out their website. Quick compliance and disclaimer slide, and welcome to our friends from ASIC if you're joining us this morning. For anybody who is joining us for the first time, the companies we generally have on here, generally every second week, kept under 300 million in revenue and approaching cash flow break even, or indeed are already profitable. So we generally don't tend to have companies from the resource and biotech sectors, and then we cover what I call industrial microcaps, which covers everything from financial services to tech to consumer to hardcore industrial businesses. Structure this morning's webinar, we've got, three companies presenting this morning, each with a 30-minute slot broken down into a 20-minute preso and 10 minutes of Q&A. If you do have any questions, please type them in the Q&A box rather than the chat function. Just makes it easier for me to moderate the questions to our presenters. And please note the webinar is being recorded and will be posted on the Coffee Microcaps YouTube channel tomorrow morning. In terms of following us, you can get us on all the major platforms. Twitter, probably our main one. YouTube, as I said, for recording this webinar. Indeed, we've got over 100 other previous webinars on there, well over 200 microcap companies on there. LinkedIn, and I do write a free monthly newsletter that you can get on the Substack platform. First up, we're going to hear from Daniel Foggo from Plenti Group. Then 9:30, we're going to be welcoming back John Kelly from Atomo Diagnostics, who should be no stranger to regular attendees here. And then finally, we're going to be welcoming back Pete McGrath from Comms Group. But that's enough from me. So I'm going to stop sharing my screen. And Daniel, who's waiting patiently there, if you want to start sharing your presentation deck, Daniel, I'll let you know once it's up on screen here.
Very good.
That's coming through now. Yeah, I can see the cover slide of your deck now, Daniel, so you can take it away.
Very good. Oh, thank you very much, Mark, for hosting me this morning, and thank you everyone for joining. Apologies, I don't have an Irish accent. I understand not just Mark, but one of the other presenters today does, but I will do my best to keep it a little bit light and entertaining as I go. So I'm delighted to introduce you to Plenti. Plenti is a technology-led lending and investment business. We describe ourselves as Australia's largest fintech consumer lender. We're cash impact positive. The key differentiator of our business, as we describe it, is really the technology. We own our own technology platform, end-to-end platform. We have over 200 staff, but about a quarter of whom are focused on product and technology. And that is a key differentiator, which has helped us grow really strongly and also drive improving economics as we scale. We've been lending for nearly 10 years, and we have a very strong credit track record. We're very much a prime lending business. We're focused on three lending verticals, so automotive finance, renewable energy finance, so that's predominantly solar panels, home batteries, and related equipment, and personal lending. A key differentiator of our business is also the diversity of our funding. So we actually started life as a peer-to-peer lender, and we've now got over a $2 billion loan portfolio, but about 10% of that is still funded by mum and dad investors, which is something that we really like to maintain, and also provides a really flexible form of funding for our business. In terms of what we're about, what we're trying to do, I mean, first and foremost, we're trying to deliver really good experiences to our customers and help them get on with life, bring their big ideas to life. And our mission as a business is to build Australia's best lender. We delivered our results for FY24 on Wednesday last week, or released them last week. And I have in this deck just some of the slides that I want to talk to in those results, which give a bit of an overview of the business, but also focus on our recent performance. And I'll also talk a little bit to where we're going from here. So moving to a highlight of the highlights of our year just gone. I think in terms of scale, and I mentioned the sort of, the technology-led nature of our business. What we've got is a great platform business where, as we scale, we can do that in a cost-effective way. So the bigger we get, the better the economics that we can drive. And pleasingly, in the last year, we grew our originations to $1.2 billion. Our loan portfolio closed up 21% at $2.1 billion. But actually, over the average portfolio actually grew 28% year on year, which helped our revenue grow 47%. And stronger revenue fed through to a growth in our cash impact performance. I think most of you will be familiar with the fact that for lending businesses, the last year or two has had a few challenges, and that we've seen interest rates go up. And that means during different periods, there'd been some pressure on net interest margins. And we also saw, losses go very low during the COVID period, but this sort of ticked up more typical levels. And so when we think of the last year, meant that we're still able to grow our profitability at a time when most of us will go into the scale of their loan portfolio or their profitability. And I think that's a real differentiator in these results. Then just a little bit more information there around our cost to income. I'll talk to that in a little bit, that we have been able to drive that substantially lower year on year, which really comes to the economics of the business. And our loss rate was just over 1%, which is very low for a consumer lending business, and arrears finished at a healthy level. During the year with NAB, where we are going to provide a series of NAB powered by Plenti products, and also Plenti owned products by Plenti automotive loan. I'm just focusing on growth. You can see that we've very consistently grown our loan portfolio, and that's fed through to revenue year on year. We listed the business back in 2020 with the loan portfolio of around $400 million. As mentioned, that's a bit over $2 billion now. What we've successfully been able to do is continue to add more strings to our bow, if you like. We've continued to diversify our business. You can see here we focus on the three channels that we're in. We started in personal lending and have diversified into auto and renewable energy. I would like to be reporting next year and the year after that, the NAB partnership in particular, adding a new color to that chart and help supporting that growth. In terms of profitability, you can see there, this is cash impact. So this excludes a few non-cash items, most notably expected credit losses. So from an accounting sense, when you grow a loan portfolio, you put in your P&L the expected credit losses, but you don't get the benefit of the future NIM or the margin that you make from that. So we like to look at profitability on the cash impact basis, which is more a sort of reflection of the true cash flows of the business. And pleasingly, that has gone up consistently. And as I mentioned in the last year, with a few headwinds, we were still able to grow that. Very briefly on the channels we're in, automotive finance is a really large market. There's over, and by our estimates, over $70 billion of loans outstanding. We've grown strongly over recent years, as you can see from this chart, but we're still a relatively small player in a large market. We initially focused on building scale in the broker channel. We've successfully diversified, leveraged our technology capabilities to extend beyond the broker channel. First of all, Tesla, we are one of their two panel lenders. So if you purchase a Tesla online, then you'll be able to select Plenti Finance and go through a very seamless and integrated finance application experience with Tesla. So we have a program to continue to build out our distribution via manufacturers, but also to move into the broker channel. That's the largest distribution channel in the Australian market. around 40% of finance originations. And that is something that we've started to take initial steps to move into. So when we couple the growth we're achieving in the broker channel, you add the OEM market, the dealer market, and the NAB partnership, we'd obviously like to see our auto book grow to be a more substantial proportion of the automotive market in Australia. Very briefly on renewable energy, this, as I mentioned, this is really funding solar panels and home batteries. We're one of 3 players that are at scale focused on the installation market. So we work with around 700 firms, ranging from electricians to large companies like AGL, and we work with them to fund their customers into installing equipment. One key differentiator of our presence here is we've got a real focus on home batteries. So as you can see there, around 26% of the installations we funded included batteries. That's a really exciting part of the renewable market. There were around 340,000 installations of solar panels last year, but only around 60,000 installations of home batteries. That's the part of the market that's growing quite quickly, 30% year on year. And you won't be surprised when people put in a home battery, that's more commonly will they want finance, because it's a larger purchase. When you've got a battery, it might be sort of $15,000 to $20,000. One other thing to mention there is we have built a really neat platform called Green Connect, and that is helping us build share in that market. We're basically simplifying the process for people who want to install this equipment, to bring together the purchase of the equipment, entering into a plan with an energy provider like AGL or others, and then also facilitating the connection to a virtual power plant, which means the economics for a battery and solar system make more sense. Thirdly, we provide our finance and your application form with some discounts and some of our partners. That's a compelling proposition to both the installer and the end customer. Just moving to personal lending, we actually tightened our credit criteria at the start of last year in the personal loan market. Obviously, with interest rates going up, some less certainty around household budgets or free cash flows. And that's actually boded really well for our credit performance, but it does mean that our originations were reasonably flat in the last 12 months, but our loan book continued to grow. We still see opportunities to grow our share in the personal loan market. We've got a loan book there, as you can see, of around $650 million in a market that's over $12 billion, of which one of the banks still has around 40% market share. So we still feel there's a long way to go there. Where we had great success in the last 12 months was lending directly to consumers. That's cross-selling to our existing customers or advertising digitally, etc. And that lending grew 17% year on year. Moving to our next slide, I mentioned the technology focus of our business. And that is the key differentiator that has allowed us to consistently build scale and do more things. I also mentioned our partnership with NAB. You won't be surprised with NAB. We actually spent over $12 million in technology investment. A lot of that was really for the future, for growth initiatives. And we expense all of that through our P&L. So the cash NPAT number that we report is after all of that investment in our technology platform. So a combination of growth and efficiency measures was sort of advanced during the year. Again, coming to technology and just doing things in a more efficient way the whole time as we scale, you can see some really great metrics here in terms of how we're able to drive better economics as we scale. One anecdote there is, 18 months ago, we had 40 people working in Manila, helping, in sort of quasi-customer service roles, processing loan applications. We've wound that down. Technology has replaced 75 to 80% of the activities overseas. And now what we continue to do is done domestically, and that's leading to better customer service, faster experiences, and obviously much lower cost. and we have a program to continue to deliver efficiencies as we scale. On credit performance, as I mentioned, we're very much a prime lending business. You can see the average comprehensive Equifax credit score of our customers on the chart on the right there. It is very high at about 835. For the credit, credit active population in Australia, it's more where that line is, where you can see where the Australian sort of bank credit score is for the personal loan books. So substantially above sort of average credit profiles. And you can see that in our credit performance on the chart on the left. We have tracked very low relative to the broader industry. One thing to bear in mind when you look at that chart is we don't expect the loss rate to go back to the levels it might have been in 2019, because at that time our loan portfolio was around 95% personal loans. It's now less than 30% personal loans. It's predominantly secured automotive finance and renewable energy loans. They are typically much lower loss loans to be making. The automotive loans are secured, you can collect on the asset. Renewable energy loans are typically to homeowners and therefore relatively small amounts. Just to give you a little bit of flavor around what we see as a really exciting thing coming up in our business is the launch of a NAB powered by Plenti automotive loan. That's the first product that we are launching with NAB through our strategic partnership. You can see here some screenshots of what the product's going to look like. It is going to be available to NAB customers in their internet banking and their mobile app. It's a pretty slick experience. We're really excited to get this in the hands of customers. I think it's a really pleasing result. We think this is going to be the best direct consumer automotive loan experience in Australia by some margin. And so we'd really like to see this resonate with NAB customers. NAB has over 5 million personal banking customers, so making this available to those customers and obviously with Plenti's brand attached to that is a very exciting moment in the evolution of the development of our business. We expect to launch this product for phase 1 in June, so that'll be made available to NAB staff, of which there are over 30,000. So once we get all that right and everyone's happy with that, we'll launch that more broadly to NAB's whole customer base. We will be updating investors or the ASX as we reach different milestones with this product, notably phase 1, 2, and 3. I won't dwell too much on our profit and give some insight into how we're thinking around growth, profitability, and efficiency. I think it's fair to say at the start of the financial year, we keep these reasonable company, our ambition at the moment. The partnership with strategic partnership with NAB is obviously an important part of that, but we're also expecting to continue to drive growth in our core business as we've done every year to date. On profitability, we despite the headwinds we experienced in the last year, we grew our profitability, and certainly in the year ahead, as we scale, we expect that to continue. And then efficiency is a really important aspect of our business. We have set a target to drive $25 million of cost benefits as we scale or double the loan book from $1.5 billion to $3 billion. We provided a chart in our full results presentation that showed we're very much keeping on target to do that. So that really just goes to the economies of scale that we can achieve. So there we go. We think we're in an exciting space at the moment. We've got some great opportunities in front of us across each of our 3 lending verticals in terms of both growth. We've got an exciting partnership with NAB, which is really coming to life after a lot of work over the last 12 months. And as you would expect, a few other things in the hopper to hopefully continue to keep up the momentum. So over to you, Mark.
Thanks, Daniel. We've got a few questions here. The first one, I was an early Plenti borrower for short-term EV loan, really like the portal and the self-management functionality. Is the new app with NAB very different to the web-based portal? So maybe just a comment on how it's going to look.
So from the NAB side, it will be very seamless to be able to apply for a loan, for example, and then you'll be transported to a website hosted by us for a full application. Once you're an existing customer, yes, we'll also host a portal or a borrow portal where you can repay your loan early, do those other things, self-service if you like. And so that will be very much like our existing experience for customers.
Yeah. Bit more of a technical regulatory one. Some comments around proposed variations to the credit reporting code and how that could impact you and how you might mitigate the impact.
Good question. You might have seen an article in the AFR about this a couple of weeks ago, and as you would imagine, we were a real protagonist to bring some light to what we see as a potential issue in the industry. Basically, where the whole industry is looking to change the way that lenders do the credit search, moving from a Privacy Act regime to a more formal sort of credit search regime. And I think the entity that was given responsibility for taking care of that sort of managed to sort of make a proposal which saw a bit of the information that we can access when we do our initial quote for customers sort of fell away. We think that would be bad for competition, bad for businesses like us. And so we wanted to shine a light on the issue. And we are confident that it will be resolved as it is reviewed by different regulators. First of all, the AOIC over coming months, and then there's an Attorney General review of the whole credit search regime later this year. But we wanted to make sure that it was brought to their attention. In a scenario where it's not resolved, we would have less information available to us, not when we're fully underwriting a loan, but just when we're giving applicants an initial quote. It would be most relevant to our personal lending direct-to-consumer business, which is about 15% of our lending. And it would mean we'd have to put in some extra friction into the process when we're giving a quote, which is not a good thing. We don't think it will come to pass, but not something that we see as harmful across all of our business.
Then just on the NAB partnership, I don't know if you mentioned it when you were talking there, but the length of the phase 1 part of the NAB partnership, is it a 3-month, 6-month thing? I mean, obviously in these phase 1 things, it's there's a bit of tweaking and sorting out bugs and stuff, and improving the UI and UX experience. So maybe just in broad terms.
Well, the good news is that the experience is built. It's had very thorough testing, and so from that context, I think actually we'll be able to, within a couple of weeks, be pretty confident to make it available to the broader public. Obviously, we're working with the bank, and there's processes that they will need to go through. So we would guide more to a couple of months for just making it available to NAB staff. But really, we expect volumes to tick up more in sort of August, September, October. Once everyone's got confidence to sort of scale. Obviously, it's really important we get it right, deliver the right experience to customers. Both parties are really aligned in that regard. And so, whether that is extended a bit longer, it doesn't really change the volumes we expect to reach a bit further down the track. I think maybe one thing I didn't touch on is, coupled with the strategic partnership we signed with NAB, is also an equity investment agreement. So NAB has a right to invest up to or acquire up to 15% of Plenti's shares, firstly on market purchases, and then also to placement. So they've got a right for their first placement of up to 5% of our stock within the first 2 months of the launch of the product. So we're obviously approaching that. The price for that placement is 90 cents, obviously substantially above current trading. Or 25% above spot, same number, so 90 cents. So, we'll keep the market updated on what happens there.
Okay, that was actually another question, so we've covered that one as well. Question on volume of loans originated through the Tesla partnership. I think they're trying to get a bit of color on how much of the AHO book is coming via the Tesla one versus the various other channels that you have.
So the Tesla relationship is really interesting. We have been told by Tesla that the integration we have with them is the deepest integration they have with any financier globally, and that really comes to the technology capabilities of our business. So we make it very easy, not just for the end customer, but also for Tesla. When they have a ship come into harbour with lots of cars, it's all can obviously be a bit chaotic when everyone's collecting the car at once. You've got to make sure everything's in order, you know, and the lead up to that, and that there's no negative surprises at the delivery date. And so our integration makes that really easy. I think we were getting good traction with Tesla, but then obviously there was an incentive put in place around novated leases and the fringe benefit tax benefits there. So what we've seen is a lot of EV buyers now are using a novated lease. If you are getting an EV, I suggest you actually look at a novated lease. We don't provide novated leases. So certainly the volume of our lending into EVs and Tesla specifically has come off a lot in the last 12 months. But you know, that is not expected to be a long-term sort of tax benefit. So we expect a return to sort of loan funding in due course, which will be good for us. Obviously, we're able to move into the novated lease market, and that's something we're evaluating.
Then a question just on the kind of environment. You know, what are you seeing in the industry competitors in terms of, you know, machinations with rates and incentives and you know, things like that? Is it becoming, you know, more competitive? Are people chasing volume over margin, or, you know, what's the kind of current lie of the land in this space?
I think it's a great question. Actually, you've got to really answer that by looking back in the last couple of years. I think as we saw interest rates increasing, which really started a couple of years ago, a few things happened. One, consumers got much more rate conscious. And then two, some large players would be quite slow to put up their borrow rates when the funding costs went up. And obviously for a business like Plenti, we wanted to make sure that we were passing on any funding cost increases quite quickly. So that did lead to a market where there were periods with reasonably intense competition in each of our channels at different times. But I think, and sometimes that was from really small players trying to have relevance in the markets. Sometimes it was from large players who were quite small to change their pricing. We actually think that the pricing dynamics and the competition in each of our verticals now is better than it has been for some time, which is really pleasing. We've probably seen a few of the smaller players wash out of some of the segments we're in, just because of, you know, more challenging markets, which has meant, you know, you needed scale and profitability and other things to survive. And some others just shrink in terms of relevance. And you've seen a lot of the large players now we've got some more stable funding, price their loans in what we think are more sort of sensible ways. So the competitive dynamic in totality is certainly better than we've seen for some time.
Yeah. Then another question here. Has the repricing of the back book already been completed and washed through the results?
Well, we actually hedge our loans every sort of week or two. So repricing of funding cost change, it doesn't actually impact our back book. It's only on new origination. So that's quite important. We lock in the contribution or the margins, if you like, from our loans as we fund them. If we're funding them via, you know, a retail investor platform, then that's locked in on day one. If it's via a warehouse and sort of ABS or warehouse structures with banks, then yeah, it's normally within a couple of weeks we lock in that funding. What is interesting is if we move into a world where interest rates start going down, as I mentioned, you know, you get headwinds as a lending business if rates are going up just on your new originations. When rates are going down, sometimes you get pockets of air and can get better margins for a period as well, because some of the larger players are obviously slower to sort of put rates down at the same time. So, you know, I think if we see stability in funding costs, which we're now seeing, that is good in terms of our overall margins. If we see funding costs go down, then that's even better. But it doesn't really impact the back book. It's all about new originations.
And then a question around credit losses across the three divisions. Is there any kind of one, you know, sticking out, or has the trends kind of stabilized, you know, kind of across all three?
Pretty stable actually in terms of across the three, in terms of expectations at least. So we generally say our automotive loans, the sort of customers we fund and how we fund them, annualized losses would be 50 to 80 basis points. And so, you know, no news or surprises there. Renewable energy, similar, and personal loans, you know, up around 3%. What we saw is during the COVID period was somewhat lower than that. we're now back at those sorts of levels. So no particular surprises. I think what we did see is in the run up to Christmas and into year end, a bit of a usual seasonal bump around arrears. But actually quite pleasingly, I think as most lenders are seeing, we're seeing the usual seasonal trends from March as they sort of wash through and your arrears tick down a bit. So no particular surprises in terms of credit trends at the moment, albeit our loss rate in FY23 was only 68 basis points. We knew that was a sort of false low and that it would increase, and we're very clear to investors around that. Last year it was 1.06%. We do expect the year ahead will be a bit higher because that's currently where we are, and in our results we talk a bit too. In the last few months it was around, I think, 117 basis points. So that's more sort of when you go back to the mix of our loan book across the verticals and the loss rates I indicated, you'd expect it to be above 1%.
Okay, perfect. Daniel, we're just up on time right as we speak, so we're going to leave it there. Thank you very much for joining us this morning, and yeah, hopefully we can get you back on maybe in the back end of 24 to talk through how the NAB partnership has gone.
Perfect. Thank you very much, Mark. Chat soon. Bye.
Thank you. And I do know we have our second presenter of the morning standing by. We have John Kelly from Atomo Diagnostics. John, if I could ask you to start sharing your screen, I'll let you know when I can see us coming through. Yeah, I can see the cover slide of your presentation now, John.
Very good. Can you hear me as well?
I can just maybe turn up your volume a slight bit. You're a little bit low.
Okay, that better?
Yeah, that's better. Thanks, John.
All right. Okay, we've got audio and visual. So thanks for having me on the call, Mark. Happy to get started with the presentation. So thank you, everyone. I'm John Kelly, founder and CEO of Atomo Diagnostics. And when we talk about why Atomo, really what we're offering the market and industry as well is a highly differentiated late stage technology that improves the rapid test experience for consumers as well as for healthcare professionals, and offers a much improved level of not just reliability but also user preference, and that's increasingly important in a consumer focused market. Our technology is developed by Atomo, patented and fully owned by Atomo, and has been used to commercialize a number of different platforms that we'll talk about in the presentation, as well as support a number of different clinical applications. And we'll talk a little bit about the two areas of finished product delivery that we're really focused on as a business, that being women's health and sexual health, as well as our OEM business, where we supply our technology in different stages of market readiness to other diagnostic companies, increasingly talking with some larger companies off the back of a number of deliverables over the last 12 months. We're headquartered in Sydney, Australia, but our operations are offshore, and our manufacturing is done for HIV testing in South Africa, and that gives us a good cost of goods platform, as well as meeting a number of tender bonus credentials for global health tenders. We have a number of partnerships already in place for OEM customer supply, and they have taken our products to market and been successful in getting regulatory approvals in key jurisdictions, including most recently in the US by way of 510K. And we are now looking to scale both that OEM business as well as the products that we commercialize ourselves under our own brand. What's driving that commercial interest, that uptick? It's really the fact that we've come to the rapid test market with a much more consumer-focused approach. We know that rapid testing is ubiquitous. Antigen testing in COVID really put rapid testing front and center of people's recognition around acceptability and willingness, as well as acceptability and reimbursement from clinicians and healthcare professionals. And that's really important because up until the pandemic, home testing was not really part of the formal healthcare ecosystem. It was really a sort of retail-driven channel, and quite a niche one at that. I think the pandemic has transformed that market, but the performance of tests in that segment still suffers from the lack of usability that those chemistry set kits deliver to market. And that's not only held back user satisfaction and user acceptability, but also the ability to get regulatory approval. And that's because of complexity, lack of intuitive use, and high error rates. Not uncommon to see error rates up around 30-40% for usability in the use of these kits. So Atomo's mission was quite simple: to take the chemistry strip that's well utilized and well accepted and to deliver it to market in a much more fit for purpose, consumer-centric solution. And we've done a very good job, we believe, on delivering that level of performance. The usability is transformative compared to the kit format that we're looking to replace. And we've seen a very, very significant reduction in errors when you use our device versus a kit. And we'll talk in the next slide about exactly what level of error reduction we've been able to deliver. But most importantly, for a consumer-focused product, consumers recognize the fit for purpose nature of the product, and we get very high levels of user satisfaction. And that's really what's driving, I think, long-term this transition to consumer home health. And we think our platform is the best platform in the world to deliver reliable blood testing at home. In independent studies, our technology has reduced blood delivery errors by more than 90%, reduced the buffer reagent delivery errors completely, so completely removed that as a common error from testing, reduced down the completion time to run a test, which is not as important in the home, but certainly very important in a primary health visit where every minute is tied to reimbursement and patient throughput. And then, as I mentioned, 90% of people who use the product believe it's easier to use than the kits. And those levels of performance and those levels of user preference, we believe, will drive user uptake of home testing, with our platform being well positioned to deliver on that, because ease of use is one of the three things that US physicians have said is critical to continued success and adoption of home testing. Kits deliver quick results and are easy and affordable to obtain, but really it's only the Atomo platform that offers that really intuitive ease of use that's needed for acceptability and reliability. That's now been recognized by way of a US 510K approval for one of our partners' products. And off the back of that, we're now seeing an interest in uptick in inbound inquiries, as well as moves towards clear waiver and ultimately OTC home approval in the US. The US being one of the few markets that we haven't as yet secured home test approval for our products. We have a modular platform that's all fully patented. We can deliver different levels of functionality to customers. It's kind of a sort of modular system in terms of what can be delivered and formatted for customers, as well as being able to skin the outside to make that product feel and appear unique for customers, a bespoke solution, if you will. And that allows us to offer licensing and supply arrangements that give customers what they need, but based off a validated modular production platform. We've started to look at pushing beyond blood into other applications. We have concepts developed for swab and saliva rapid testing, swab being the most developed from a technical perspective. And we're engaged with a couple of partners on the commercialization of that for specific applications. One that we're particularly interested in for finished product is a vaginal swab system to support chlamydia and gonorrhea testing, which is from feedback from public health as well as our retail channel partners, one of the big unmet needs in the rapid test market, and one that we have some long-term interest in. Our blood test solutions are best in class. The usability is inbuilt into the device, so the user really just has to push, bleed, and activate a buffer button to get the result. Really hard to do it incorrectly, and that really drives a high level of user performance and user repeatability. And that's driving consumer interest from our partners in retail pharmacy, but also, I think, being recognized by healthcare providers and regulators as being the way that rapid testing in the home needs to be delivered. We've taken that core IP and that core functionality and redeployed it into a swab test device. We've shown in some lab testing that we can improve signal strength on a typical rapid assay for COVID by about 80%. We have high expectations that that level of performance improvement can be translated to other swab-based applications, and in particular for anything that requires quantitation. In the analyte result, our ability to deliver a very controlled volume of sample to the assay puts it in a much better position than a standard swab kit to deliver that level of precision. Had a lot of interest from that, and very excited about the opportunities to commercialize that in parallel with blood testing over the medium term. Important slide, I think, to really focus on. The technology is now fully commercialized. We're through R&D. We've got regulatory approvals. We have customers that buy the test devices from us and use that to secure customer contracts in their markets, as well as regulatory approval. We have 2 platforms commercialized now across different markets. We have our own HIV self-test registered in more than 40 countries, and we sell actively in global health markets, Europe and here in Australia. We also have partnerships with NG Biotech and Lumos for pregnancy and antimicrobial screening, and those products also have a range of regulatory approvals, including most recently with FebriDx, a US 510(k) clearance. That gives us not only scope for expansion of our applications, but also regulatory predicates that we can give to other potential customers who are interested in coming to market. And that's been a particular benefit in recent conversations with partners in the US market, where we see a lot of long-term opportunity for CLIA-waived testing in small primary health and pharmacy clinics, as well as OTC approval for home use. Just very quickly talk about those 3 core businesses. Obviously, the OEM business is the supply of our platforms to other partners. That is an attractive business channel for us because we don't, as a business, have to fund all of the clinical and regulatory go-to-market associated with getting that product into revenue. We have Pascal and Galileo platforms commercialized now. We have completed development work with Elion and are looking to find a commercial partner for that. We have done a lot of work on the digital platform, which allows us to quantitate results, and we have some patents around how we can do that accurately and deliver quantitation in the home. Our swab device, Curie, is developed and looking now to go to market, as well as Fleming, which is a combo application that allows us to test for more than one test strip in a single device. All of those are addressing an unmet need in the market in terms of usability, and we are looking to bring all of those to market over the medium term. If we look at that pipeline by application, we'll see that that's spread across a couple of different areas. HIV gives us a solid footprint in sexual health. We have been working with the Burnet Institute, Burnet Diagnostics out of Melbourne, on a rapid syphilis test, and we're very excited about the prospects for that. We'll talk a little bit about what that test might mean for us as a company. And as I mentioned previously, the Valve platform is ideally suited to support chlamydia, gonorrhea at-home testing, and that allows us as a business to really focus and partner with companies interested in sexual health, which is probably one of the, if not the largest, addressable market for home testing, we feel, over the next 5 to 10 years. Outside of that, our partnership with NG Biotech has seen us look to bring products to market in the area of pregnancy, and we're also well advanced with commercialization of a ferritin test, which is a marker associated with anemia and iron deficiency, and that also disproportionately affects women, and in particular pregnant women. So that fits quite nicely in with that women's health portfolio that we're looking to build and license and supply. Outside of those 2 applications, longer term, we're seeing a lot of interest from our channel partners, particularly in Europe, for tests that can quantitate testosterone and vitamin D levels. Not exclusively those 2, also applications like thyroid are of interest, but they're the 2 that we think provide the most value to the market in terms of volume and demand, and we're in the process of engaging with potential assay partners that can provide those tests to market, and we would be looking to have channel partners downstream helping to fund the go-to-market costs and getting those products commercialized. If we look at our OEM business, we have obviously a relationship with Lumos, who have launched the product in, most recently, the US for FebriDx. They had, prior to that, approvals in Australia, Health Canada, as well as Europe. We're seeing a recommencement of ordering post the resumption of normal business after COVID, and we're expecting to see some sizable scale up in that business over the medium term as that product becomes more entrenched and scaled up in those key markets. We've had a long-term partnership with NG Biotech, predating COVID, where they developed on our platform a blood-based pregnancy test. A number of studies have shown that HCG, the biomarker for pregnancy, builds up in blood earlier than it does in urine, making it more suitable for early detection, and also is much less variable through the day compared to urine as a sample type. And that also makes it much more reliable in that early phase because it doesn't depend on whether you're measuring first flow or flow later in the day. With urine tests, that has a big impact. So they're showing some success with their market entry in Europe. They've launched in France, the UK, and recently announced a contract with a pharmaceutical company taking that product to Italy, Portugal, and Spain, and also have registered it in Brazil. We're in the process of looking to secure regulatory approvals for that product in Australia and have the rights to the commercialization of that product also in the US, and are talking to some potential partners around what a US market entry might look like. Pleased to see that both those products have not only been able to secure regulatory approval, but secure approvals across multiple jurisdictions. And that's really helped us, as I mentioned, with other downstream conversations around opportunities outside of those applications for companies that are interested in the usability that our platform delivers, and being able to show that they have an existing product approval in market for a similar class of product is very, very helpful. In terms of customers, we have a number of ongoing inquiries. Some of them have progressed through to initial purchases of product samples for evaluation, and that ranges from university-based spin-outs to SMEs and a number of larger companies, including one top 10 global IVD company. So that's really encouraging, particularly on the engagement with larger companies. Pre-COVID, pre-FDA approval, that was not typically the case. So we are starting to see, I think, an increased level of recognition and interest in our platforms that we ultimately expect to transition through to development and full supply agreements over time, so that we can build the customer base for Pascal and other applications. In terms of sexual health, obviously our HIV business is the core finished product business that we have. We've got three main business segments: Newfoundland, our partner for UK and Europe, and most recently an expansion into Colombia, opportunities to expand that relationship further. We have supplied to them so far through this contract 250,000 tests. That agreement's about a year old, and we'll be looking to extend that for a further, hopefully 5-year period. We have recently had approval for Colombia and launched there, and we expect Switzerland and Eastern Europe to come online later this calendar year. So that offers, I think, a long-term partnership with a proven partner that can get product in the market. They were able to get the product launched into Tesco supermarkets in the UK, and we think that level of pharmacy retail penetration is really encouraging through that channel, and we're in discussions with them around the expansion of our relationship to include other products beyond HIV. In global health markets, we've had a long-term partner, Viatris. They have ordered more than 500,000 tests from us in the second half of this financial year, so since the start of calendar year 24, and that is encouraging to see. A large part of that interest, we think, relates to the fact that we're the only pre-qualified manufacturer of HIV self-test that is delivering product from a production facility in Africa. That not only supports a number of core deliverables within global health sustainability, but also reduces our environmental footprint, and more importantly, our ability to deliver quickly into tenders in the African market. And we're starting to see increased demand through that and expect that to continue to grow over the medium term. And then finally, in Australia, we have the only HIV self-test on the market, the only one that's been approved by the Australian TGA and listed on the ARTG. We've gone to a lot of effort to try to build that approval and that market. We are now in hundreds of pharmacies across the country, and most recently we're very pleased to see that the pilot programs that we've been involved in the creation of have now been recognized by government as increasingly important to access high-risk cohorts, and that those pilots have received some significant funding from government over the next couple of years by way of the recent budget announcement. And we're working with both those partners in the at-home meal program, as well as the national expansion of vending machines, to understand what that looks like in terms of product demand and product revenue for Atomo over the coming years. And once that's clear, we'll certainly come back and update the market on the details around that. But overall, starting to see, significant interest in our HIV product globally, and expect to see ongoing demand and scale up into new markets over the period. Mentioned syphilis. Active syphilis is a very exciting opportunity. At the moment, the syphilis rapid tests on the market really only detect antibodies, and antibodies are present with active infection, but also are also relatively high in concentration post-treatment of a recent infection, which means a lot of tests that turn up reactive are actually not active syphilis cases. They are past-treated infections. Burnett have developed an assay that's fairly unique in being able to distinguish between the two, which means that its reactive result indicates active infection, and that has a number of benefits in terms of reducing down the requirement for secondary screening, as well as also reducing down the amount of people being sent through for additional confirmatory testing that's not necessary. We're very excited about the data they presented. We've been working with them to put that test onto our platform and go to market with some improved usability, as well as taking over, we believe, the manufacturing commercialization of that product at the right point in time. So that's very exciting, and we're starting to see a lot of interest, not just from public health in Australia, but more broadly across the globe and also in global health. As we mentioned in sexual health, we have significant demand expressed from partners for chlamydia and gonorrhea, and we are interested in that as a medium-term, longer-term opportunity past the syphilis opportunity, but still see that as adding significant value longer term to the business. If we then look at women's health as a focus category, we have a partnership with NG Biotech, where they've launched the product in a number of markets in Europe, and we're also looking at Australia and US longer term. That's a very big market. Pregnancy is one of the most established at-home rapid tests, even pre-COVID. It was a mainstay of home testing. We've done some independent market research, 300 women in Australia that have recently bought a pregnancy test, and 1 in 5 expressed interest in a blood test that was able to detect more accurately in that early phase. And 1 in 5 is still a very sizable market, given the overall size of pregnancy testing. And we are looking at seeing how NG have been going with various market launches in their markets, as well as how they have been able to message the product relative to urine. So we'll be able to take some learnings from that for any markets that we launch into. Just going to finish up with a bit of a summary on our financials. Our revenue over the period has started to pick up in the first half of this FY, and that reflects a normalization of business post-COVID and increase in our HIV business, as well as resumption of OEM contract supply. We're seeing that starting to flow through to gross profit, but increasingly we're seeing an improvement in the underlying gross margin as well, and that reflects, I think, an expansion of business beyond the global health supply of HIV, which was not our most profitable business channel. And I think sales into Australia and Europe obviously help offset that and give us a better blended margin. On the other side of the ledger, we've been very focused on our operating expenditure. It's been coming down consistently over the last couple of years as we've focused on consolidating the costs in the business. Our OPEX has been managed. Our CAPEX has been essentially invested. We have validated production and scale available to us, so we don't need to put additional CAPEX into the business to scale up our revenue. And that improvement in revenues and reduction in OPEX has seen our EBIT losses starting to narrow as we track towards break even, and that's an encouraging trajectory that we're keen to continue to see progress. That's the presentation. Mark, happy to take any calls that you might have.
Cheers, thanks, John. Maybe if we could just talk about the budget, since it wasn't too long ago, on the rollout of HIV testing nationally. I know you've been quite involved in that. What are like kind of some of the steps that have to happen now before that starts translating into vending machines on site and people being able to buy these self-tests themselves, where it's a pharmacy? Is it the money gets transferred to state governments and, they have to now come up with a program per state, or how does it, what are the kind of mechanical steps that need to happen before, I guess, you start to see it flowing through your business?
Yeah, so it's a great question. So if we look at the at-home meal program, it's already been set up and piloted by Atomo and NAPWA, who run it, and the promotion of that has been managed by Grindr, who have access to a lot of the cohorts that we want to see do more testing. So that pilot already exists. It's been validated. The back end's already in place, and that program has been running since October, and we've been already seeing sales through that channel, and that's been responsible for the recent step up in our HIV volume. That was a limited pilot that had a limited set of funds available, and the government budget has now, in essence, expanded and extended that program. So our expectation is, as the money is made available to NAPWA for that program, that we will then see more promotion from Grindr and then more demand through that system. So that's ongoing, but what we do expect to see is a step up in access through that program, and we're working with NAPWA to try and understand the timing and volumes associated with that. With regard to the vending machine, there are already vending machine programs in place in a number of states, in universities and on sex premises. They, again, have been proven very successful in getting people to test. Typically been going to clinics for testing, so it's reaching those hard to reach cohorts. That evidence is being put forward to government, and they have now decided to expand that nationally. So we'll see a very sizable scale up in the number of vending machines getting installed and operated. Obviously, there's a lead time for those machines to get installed. We would expect them to come online later this calendar year, and then we'd obviously see the volume increase on the other side of that with the introduction of those new machines.
And then a question here from the audience. Maybe it says timeline for pregnancy tests in Australia, but maybe if I just reframe it to, where you are with TGA and getting that approval, maybe just an update where you are in the regulatory process with them.
Yeah, we've been working we were working for a couple of months with NG Biotech to get some additional data made available. So the requirements from TGA were slightly different to the data set and the dossier that NG used to get their CE mark approval. So that additional data, by way of a response, was put into TGA several weeks ago. They'll be going through that. It'll be in some sort of queue. So we'll hear back from them in due course, and we'll move on from there. But it's still active, and it's with the TGA for an assessment. We went back to them last month.
Okay, and then a question on this one actually got emailed to me. OEM capacity, just with the ramp up or normalize with maybe ramp up normalization post COVID now, the capacity at the factory in South Africa, and then what that means in terms of cost of goods sold, margins, pricing for larger volumes coming from from the OEM orders, 100,000 versus 200,000, and how all that mix kind of plays up together.
Sure. So our contracts to supply the devices have some volume breaks in them, but they're relatively shallow. So it's not like we suddenly start losing lots and lots of margin as the volumes pick up, but there is some incentives for customers to order more. In terms of our installed capacity, we can do a couple of million HIV tests a year comfortably on the current footprint. We have total device capacity to make up to about 17 million cassettes per annum. Most of those are Galileo. We have 4 or 5 million available for Pascal, and the cost of scaling that is relatively modest because the tooling and assembly is relatively low cost to duplicate. The blister machine's fully invested and set up, so we've got up to 10 million per annum of blister capacity already built. So to scale up our Pascal capacity to match that, it's not a large capex investment. So we are reasonably well positioned to scale up revenue from here moving forward. And obviously with that, we would expect to see some improvements on cost of goods. We'll be able to get better pricing from suppliers if we can give them more demand and more certain demand. And that's where obviously having, you know, the likes of Viatris and others ordering regularly really helps.
Yeah. One quick one, John, if we can, we'll just try and squeeze it in here because we're just pushing up on time. STIs are mandatory reported to Commonwealth state health departments. How will point of care testing, you know, interact with that reporting to health departments?
Yeah, it's a great question. The research shows that nobody gets tested at home for an STI and then doesn't do something about it. It's not the kind of thing that you find out you have and then choose to ignore, typically. So there's very high levels of correlation between people testing at home for an infectious sexually transmitted disease and then presenting for follow-up confirmatory testing and treatment. That's been shown with HIV globally. It's also been shown with other STI applications where there have been some kind of decentralized screening offered. So we're pretty confident that there'll be a very high correlation between at-home testing and linked through to services and treatment.
Okay, cool. John, we're bang on time there, so we'll leave it for this morning. Thanks very much for coming back in and giving us an update on all things at Atomo.
Thank you for having me. Appreciate it.
And we will now hand over to our final presenter of the morning. I'm delighted to welcome back Mr. Peter McGrath from Comms Group. Peter, good morning.
Good morning, Mark. How are you?
Very well, thank you. Peter, if you want to start sharing your screen, I'll let you know when I can see the cover slide of your presentation. Yeah, I can see it there now, Peter, so you can take it away whenever you're ready.
Okay, so that's coming through properly?
Yeah, perfect. And your audio also sounds good.
Okay, great. Thank you, Mark. Okay, thanks everyone for attending this morning. I'm going to run through an update on Comms Group. We've made a couple of announcements to the market this week with some very exciting news from our perspective. We've also provided a third quarter update, and I'll cover that off this morning as well. Briefly, an introduction on Comms Group for those who are new to the business. We've been around since, as a listed company since around 2017. We're a B2B provider of telecommunications and IT services. And we leverage, if you like, the power of the cloud, where a lot of our services and applications are served from the cloud or from data centers. The company is headquartered in Sydney, but we have offices and staff located across Australia, as well as in Singapore, the Philippines, and London. And we really are a specialised provider of a number of key services, but particularly domestically, we provide services to small business, enterprise and government. And then internationally, we've been building a unified communications business where we provide services predominantly wholesale, but also to some large multinational corporates, international telcos, the likes of contact center providers, over-the-top type providers, those organizations that provide services via the internet, unified comms providers, and IT service providers. A number of years ago, we separated our business into three key divisions to give greater focus to each of those key areas. And Next Telecom is our domestic telco service provider targeting the corporate mid-market sector. On Platinum is an IT service provider. Those two businesses work closely together, but On Platinum is a specialised IT services provider, particularly delivering the latest generation in terms of modern workplace, leveraging off a lot of the Microsoft products and solutions, and also very strong with security-based solutions to assist organisations with to have a very secure IT environment. Our global business, we brand that as Comms Group Global, and you'll see there that we're a specialised UCaaS and CPaaS, which is content platform as a service provider. A couple of key highlights over the years. We've made a number of acquisitions over the last 3 or 4 years, which we've integrated into the business and into each of those key divisions. And we've pretty well extracted the synergies and got those businesses performing really well. And you'll see that from our numbers today. And in 2022, we signed a major contract with Vodafone Group PLC to be their core unified communications provider globally. And that's a significant contract. And we have quite a few resources working, supporting Vodafone globally with their endeavours. In terms of our products and services, this is for those who really don't understand what we do. But if you look at our domestic telco business, Next Telecom provides a range of voice and data services. What would differentiate Next Telecom from some of the NBN type resellers out there is the fact that they can provide to mid-market corporates and the like, basically a full telco service, including the very advanced voice services. Voice services are seeing a real renaissance in the market. They're known as unified communications today. And a lot of businesses need to be able to cater for the staff that work in the office and then work from home or on the road, etc. We call that unified communications. There's a number of key providers out there. The number one provider in the enterprise and business market is Microsoft with their Teams product. And then to integrate that to the PSTN, we call that Teams calling. We've been providing that service since way back as 2017. We were one of the first in the country and one of the first globally. And it's an extensive product offering with value adds that we also sell. And Next Telecom is a major provider of that service in the marketplace, particularly with local government and state government. And we also provide contact center solutions and a range of other voice recording and analytics type services that help customers, mid-market corporates, become more productive in the marketplace. As you can see there, we provide a range of data services. We've been one of the larger fiber data service providers in the market for many years, and we tend to bundle these together for our customers. Within our IT services portfolio, a range of different products and services. We're typically looking at annuity, 3-year contracts minimum. We're not really a consulting outfit. We're a managed service provider, and typically we afford high gross margins in that business. And then our global business tends to sell more complex and geographically diverse unified communication services and high-end voice services for large carriers and the like that operate typically across the Asia-Pacific region or globally, and we'll cover that a little bit more in a moment. So it's a fairly diverse range of products, but a focus on B2B. We're focusing on businesses, typically from mid-market right through to large enterprise, and very specialised in the way that we go to market. In terms of our financial update for the third quarter, we're really happy with the progress of the business this year. I think a lot of the cost synergies and a lot of the work we've done in terms of the businesses working together and selling together have come through. We're showing positive overall growth in both revenue and EBITDA year to date, and a strong overall financial position. You can see there our group operating revenue, and this is unaudited obviously for the third quarter, but that's at 41.4 million. That's up circa 7%. We had a really strong March, delighted with that, circa $5 million in revenue in the month of March. So overall, we're seeing good, strong revenue growth across the business. In terms of costs, we continue to focus on our cost position. Our overall gross margin is just under 50% at 48%, so that's up slightly. And we continue to work on reducing our supplier costs. We do buy a range of, if you like, commodity services from the market, from the wholesale market, such as fiber and NBN tails, etc. We can then add the value to that and make a very high gross margin. We expect to continue to focus on seeing reductions in supply costs into the next financial year. Our operating costs have been kept largely flat year to date, and we also rationalise some office space in the Sydney CBD, which will save circa $700,000 per annum. Our group underlying EBITDA for the 3 quarters or for the 9 months, 5.1 million unaudited. That's up 46% on the previous corresponding period. And it's highlighting that all three areas of the business have seen strong profit growth, and we're reaffirming our guidance for FY24 of revenue 53 to 55 million and underlying EBITDA of 6.5 to 7 million. I'll just turn now to an update on the business and what we've been doing in the business, predominantly in the last quarter, but the last 9 months, in fact, some very exciting initiatives that we've had underway. If we look at our global business, which really has resources in Australia, Philippines, Singapore, and London today, we have an extensive expansion occurring across the Asia Pacific. We're seeing solid growth opportunities and emanating from carriers and large, if you like, contact center providers and over-the-top providers out of USA and Europe. They're wanting to deal with someone that they can trust, who's a reliable provider and with high levels of customer service. They also look for automation, so they can order services automatically via a portal or via an API type arrangement, and also they want coverage. So that's what we've been doing, expanding our coverage to be able to service these customers. If you look at Microsoft Teams calling, it's probably it's definitely the leader in the enterprise and mid-market corporate and government space globally in terms of organizations moving to Teams to do their telephony PSTN calling. The latest generation of that is called Operator Connect. I won't go into the details on that. I've covered that in a previous presentation, but suffice to say that we are adding a number of countries to that. We want to be a key provider in the Operator Connect space, as we are with Teams Direct Routing. We also recently added Cisco WebEx calling capability to our UCaaS offerings. That's predominantly for Australia and the Asia Pacific. Our Vodafone relationship continues on a really positive trajectory. So that relationship is with Vodafone Group PLC out of London. We provide services for them globally. We've had additional customers added. We've added new products over the last 12 months, and we're working on supplementing the global voice coverage with additional countries for Vodafone as well. We've had to add additional resources to support our global business, to support the expected growth. Nonetheless, this year we expect to see revenue growth overall, and for the 9 months year to date, our EBITDA is 1.6 million, which is an increase on the same period last year, which was 1 million. Really happy to announce this week that we secured a number of key voice licenses across the Asia Pacific region, with which we spent considerable time and effort on. So we already had licenses in Australia, New Zealand, and Singapore, and over the last 9 months, we've secured additional licenses in Hong Kong, Indonesia, Japan, Malaysia, Philippines, and Taiwan are pending, but we expect to hear news on those very shortly. We have full voice services licenses in these countries. We would be probably the only or one of the very few companies globally or carriers globally that has this coverage today. And then in a number of other parts of Asia, such as China, South Korea, Thailand, and Vietnam, we have legal arrangements in place under a partnership arrangement with local carriers to provide services there. So really excited with the announcement that we put out a couple of days ago in relation to our expansion, particularly with licenses in the Asia Pacific. The relevance of this is in many countries in the Asia Pacific, you cannot provide local voice services, which means you cannot provide Microsoft Teams calling and the like unless you have a license. So as I say, we're really excited with where we've got to. We're also expanding our footprint into South America and Africa, and that's currently underway. This is what our global map looks like now in terms of points of presence or voice session border controllers. These are state-of-the-art, modern, very powerful voice switches that operate in the public cloud environment. We have 6 key points of presence and then a number of other smaller or minor points of presence across Asia. In many of the countries, we need to install a point of presence. And you'll see there we've listed the countries now where we have key capability and particularly licenses. Typically within a region where we put a point of presence, we will then connect to the local telcos, which we need to have an agreement with. And then we'll also connect to the unified comms providers, whether that be Microsoft, whether that be Cisco, WebEx, etc. What this network enables us to do is provide a full range of advanced voice services to our customers, whether they are intermediaries such as carriers, or whether they are the end corporates, the multinational corporations that are really looking for a single provider around the world now. Next Telecoms, our domestic telco services provider. As I mentioned before, we're seeing key in-demand products today, including fibre and NBN broadband, Microsoft Teams calling. They were a pioneer and early provider of those services. And we're also providing Teams calling value-add offerings. We're also seeing strong interest in the contact centre and Teams video conferencing areas. We've seen good sales year to date from Next Telecom. We're focusing that business more so now on the mid-market, government and corporate sectors, although we do have an extensive customer base, from SME right through to mid-market. We've had very good success year to date in the local government sector, and we've got some significant opportunities in the pipeline there. Profitability of the business continues to increase, with underlying EBITDA for the 9 months of 3.3 million, compared with 2.8 million last financial year, for the same period last year. Our On Platinum business, that's our ICT or IT services managed service provider. We've seen continued strong interest in the best-of-breed modern workplace and enhanced security solutions. So this is where we will come into a corporate, provide them with the latest solution, the latest products and services, typically a strong Microsoft suite, and then with an enhanced security solution over the top. We're seeing strong interest in the market, particularly in the corporate mid-market, for those types of solutions. Good level of new sales continued in the year with On Platinum. We've also been able to get some further cost reductions in that business in the core cloud services area, OPEX savings of 0.3 million per annum expected going forward. And we're also seeing great cross-sell synergies between our On Platinum and Next business. We have probably won about 6 key customers today. Here's an example of one that we're listing here, and this is where we've increased annual revenue from 50K. They were previously just a telco customer or taking telco services. They're now taking a managed service offering, and we've increased that to 200,000, with circa about 50% gross margin across the board. In our On Platinum business year to date, we've seen continued growth in revenue and underlying EBITDA, strong growth in EBITDA for the 9 months of 2.1 million compared with 1.2 million the previous corresponding period. And we're expecting for the full year strong revenue growth for On Platinum. That was all I wanted to cover on the business update. Just now to cover briefly our strategic review process, which we indicated to the market last year. We pretty well brought that to a point now where we put that on hold. Suffice to say, we did see strong interest in a number of our businesses. But when we stepped back from that, with the time that it was taking and then the time that we felt a transaction would have taken to get concluded, we've decided to put that process on hold for now, particularly now that we have our full year results, our audit period that's come along. But suffice to say, we saw very strong interest in the business. But for now, we put the process on hold, but we will continue to review opportunities as and when they arise. That's all I wanted to cover at this stage. Obviously very happy to take questions at this point. We have an investor website, and also if you have any inquiries, you can put those through to our investor section there.
Thanks, Peter. I have a couple of questions here. Revenue generated from the Vodafone relationship, and then I don't know if it was in that broader announcement on the Q3 update, but the cash balance at the end of Q3.
Yes, so we did make an announcement to the market on our cash balance a couple of days ago. Look, I haven't got it in front of me, but it was around about 3 million cash at bank, maybe slightly over that figure, and our net and our debt was around about, excuse me, automatic lights. It was around about just under 8 million. Your first part of your question was around Vodafone, Mark. Look, the Vodafone relationship is continued to go well. The revenues have increased there. We're adding additional customers to that, particularly their corporate customers that are coming on. We've added additional products, and these are typically high-end voice solutions that we've added for them that they'll then go and sell. And then we have a number of significant opportunities in the pipeline that we're working on with them. So we expect that continue to grow in terms of the relationship with Vodafone.
And I just want to talk on the new licenses that have come through for,
Yes.
was it 6 countries or 6 markets in total?
Yes.
In terms of getting those in place, is it now a case of you can go to existing customers, or whether they're in market or that you're, let's say working with them in Australia, but they have operations in Hong Kong or Malaysia, and say, look, we can now replicate what we do for you in Australia in Malaysia, and it's a case of, agreeing that and kind of rolling out that process? Or is it going into market now that you have the license in place and like doing new business development work and getting going with customers in there? Just want to kind of get an understanding of kind of what the expectation is now that those licenses are in place in terms of what revenue you can chase with it.
Yes, thank you, Mark. So just on that, we have 2 sets of customers that typically we can leverage these licenses for. Firstly, we have existing customers, which are typically large carriers, global carriers that could be located in the Asia-Pacific region, out of the US, out of Europe. So we sell services to them. And the fact that we now have these licenses in country, they will purchase typically what we call local voice termination services from us. So they're already out there in the market. They're potentially looking to go into these other countries, and they need a provider. So existing customers of ours, also contact center providers, very large contact center providers. I won't mention names, but investors could go to the Gartner Magic Quadrant and you'll see there's 10 exceptionally large contact center providers globally. We deal with a number of those today, and they want to know that they're dealing with a party that has a license and has a right to operate. So they're the second category. The third is corporates, multinational corporates, who are looking to bring their offices all onto a unified communication solution. Previously, they were buying their telco services locally. Example might be, say, in the Philippines. They can now come to us or come to us via their carrier, because we sell to their carriers, and get that service in, say, the Philippines, and we can provide the full range of voice services within that country. At this stage, we have no plans to set up shop and sell locally to local consumers, if you like, within those countries. We're really using these licenses to provide the services for global customers who require these services. Hopefully that explains that.
Yeah, thank you. And then a question on the strategic review, if we can maybe just talk about that for a second. In terms of, putting it on hold, as I know we're kind of moving into, as you say, like year end and all of that, but were the offers that, did come in or expressions of interest, was the pricing not right, or, there's too many conditions, or, why was...
So what I can elaborate on this is yes, there was offers that came in. Those offers from our perspective were attractive. And I think at the end of the day, though, it was more a case of the timing and some of the conditions that were attached to those. And also the view of the board in terms of where the company's at and the overall value of the business, where we stand, and weighing that up against those offers that came in. At the end of the day, I think at this point we're reassessing, do we want to sell off, component parts of the business and leave ourselves with, what is a small business listed on the ASX with the inherent risks in that? Or if we were to look at doing something strategically, we'd probably look at doing it with the whole company. That's probably the summation of where we're up to.
Okay. And in terms of, the local government, I can't remember if you said local or state government contracts that you that you have been working on and got a few over the line. What is kind of driving the success in that market? Is it just you kind of tweak the offering to be more suitable for the state government versus, a large enterprise, because these are essentially enterprise customers, or what is kind
so
of
I think in
the
the local government area, there's a couple of formulas for success there that we found. Well, firstly, we've been on the government panels for a number of years. You need to be on the panels, and we're seen as a very reliable and trusted provider. We also have extensive experience with Teams calling, and many of these organisations now, and this applies also to mid-market corporate and enterprise, are moving to Microsoft Teams calling. So they're really wanting a reliable provider. They're also typically wanting the full suite of products, such as call analytics, call recording, contact centre. And contact centre is where, a local government might have 20 or 30 staff that are taking specific calls from members of the public, from the ratepayers, and they need specific solutions for that. So I think this is what differentiates us from a number of the other, if you like, NBN resellers out there who have no specialisation in voice. Bringing that all together, you need specialist staff within your business who can bring that together in a seamless manner for the end customer. And we've had a number of the local government, very large organisations, who've been delighted with the outcome. And obviously we get referrals as well. So we have had quite a lot of success in that space. I think that helps create further success, and we've got a very solid pipeline. Obviously, we can then deliver the fibre optic links and the other services that the councils need. But their key requirements today are around how do they interface with the public, how do they interface with ratepayers, and in many cases their staff may not be at the office, they may be working remotely, and the whole theme of unified communications and how do you make that seamless, how do you provide the reporting back to the council so they can see that, how things are going, how many calls they've got, etc., etc. That's what we specialise in.
And as you say, a lot of these councils, when they see one or two taking the jump, in their area, it gives them a lot of confidence that, they're not the official guinea pig, let's say.
No, that's exactly right. And look, because there's been that move from the traditional or older style voice application, it might be their PABX in the office. They've all moved now. They've moved to the cloud. But, that's probably a little bit of an experiment for some of them. They need to make sure it's going to work and it's going to be seamless. And we have the resources, the people on the ground, the experts who can make sure that works. And as a result, we've been successful in that market, which we're really happy with.
Question in here. Potential for dividends in August. I don't know if that's on the board's radar as a more broader capital allocation.
Yeah, look, I think there's we would clearly like to look at seeing how we could give some returns to shareholders, whether that's in the form of dividends or shared buyback or something. It'll be something that the board will obviously be discussing, as we close out our full year accounts. It's probably too early to make a call on that at this stage, but into the end of this financial year, August, yeah, it's something that we'll be looking at.
Okay, perfect. Peter, I think we'll leave it there. We are just out of time, and I do want to kind of be respectful of your time and everyone else is on the call. Thank you very much for joining us, and yeah, maybe we can chat to you again in September once the full year results are out around the back end of August.
Yeah, for sure. Thank you, Mark, and thanks everyone who attended today.
Thanks everyone, and that concludes this morning's session. As I said, the recording will be up on the Coffee Microcaps YouTube channel tomorrow morning, and we will look forward to seeing you all joining us for our next event. Thank you.